yesterday, the Federal Reserve Chairman Powell stated that the interest rate change to banks will be increasing another 3/4 of a percentage point. This was the highest increase in interest rates since 1994. Some even thought that it wasn't enough and rates should have been a full point. So what does it mean to you as a consumer? All right. So first of all, you should know that the Fed isn't doing it to punish Americans. After all, well, maybe he is a Democrat. Maybe he is. Well, nah, it's not. All right. He's doing this as an attempt to stop inflation from getting any more out of control. Look, inflation is due to all the ridiculousnesses of the scamdemic, such as supply chain issues, housing pent-up demand, and the free flow of money during that time that got out of control. In my opinion, and something I've been saying for 8 years, is that the Fed needed to raise their rates when Obama was president. Obama and Trump, they should have been raising interest rates. Even Trump called on Powell to raise rates a few times, and it never happened. Many Americans have now gotten used to low rates and don't remember my generation rates of mortgage rates of 13, 14, and 15% to buy a house. Well, the younger generation is about to get a rude awakening. Look, first let me explain how the interest rate increase actually affects banks. So banks borrow money from the Federal Reserve and then use that money to lend it to you. So a 75 basis point increase means that the bank will now borrow money from the Federal Reserve for 0.75% more than they did last month. You should know that the Federal Reserve was lending banks money at 0% during the scandemic and continues to do so up until March this year. By the way, with all the current increases we've had so far, the rate is now 1.75%. So the rate that the Fed is lending to the banks is 1.75% as of today. In 2019, before the scamdemic, the rate was 2.5% at its peak. And in 1980, it was 20%. So, really, what's the big deal? We aren't anywhere even near the rate of 2019 yet, and the economy is kind of still on fire, well, at least for now. The biggest place you'll be affected in the amount of money you'll pay to borrow will be to pay to borrow money. This typically means your interest rate for mortgages, car loans, and credit cards will be higher. Look, just to be clear, if the Fed is charging banks 3%, and not even charging banks 3% yet, but if they're charging 3%, and they probably will by the end of the year, by the way, that doesn't mean your rate will go up by that amount that the Fed increased the rate. Banks can set their own loan terms and how they feel would make the most sense. So if the Fed rate is 3% and the bank adds 3% to that, it's very simple. Simple math, you'd understand that your rate would be 6%. However, some banks may choose to increase a different higher or lower rate. One bank may say that they'll charge 2.5% over the Fed rate, and another may say that they'll charge 4% over the Fed rate. There is also something called the prime rate. So the prime rate is an average rate that banks charge their best customers. Look, I've had loans that are calculated at 50 basis points below the prime rate. For example, if the prime rate was 4%, my interest rate would be 3.5%. The reality is kind of always shop around for a rate, that's fine, but to me, access for money is more important than rate at any time. I often tell my followers to get as many lines of credit as possible and use those lines of credit to make money on that borrowed money. By the way, the concept of raising interest rates to lower inflation has a lot to do with house prices. With mortgage rates rising from what was about 3% in December to a little over 6, actually I think it's almost 7 now, it changes the dynamic of how much someone can afford to budget for a house. If housing slows down, housing prices go down and inflation starts to drop. Of course, sales of cars and other items, like you may use credit for, are also going to drop because of the same calculation. So here's the head scratcher now. So think about this. Isn't raising interest rates just another form of inflation? Maybe the price of goods goes down, but the actual cost is the same or even goes up if you borrow money to buy the item. Well, maybe Dave Ramsey is right when he says buy everything cash. Yeah, I still won't do that. But I like to buy investment properties, and I like to also buy them with credit. The reason is I think it's just too heavy to carry all that cash to go to a closing. Bottom line, look, don't panic. It's only 1.75%. No big deal.